Thank you for tuning in to another episode of the Pacific Growth Strategies Chalk Talk. In today's episode, we take a look at days in inventory, which is a financial ratio we use to identify how long it takes us to convert inventory into sales. If we were a manufacturer, we would be looking at finished goods. And if we were a retailer or wholesaler, we'd be analyzing inventory acquired for resale. Now, with that note, let's get into days in inventory. All right, let's take a look at days in inventory on the chalkboard here. So, starting with the formula, we're going to take the average inventory for the period, and we're going to divide that by the cost of goods sold, and then multiply by the total number of days in the period. So we'll take the average inventory divided by the cost of goods sold, multiply by the days in the period, and that's how we get days in inventory. Now there's 5 components, so we'll start with the period range, which is April 1st through April 30th in this case. The inventory at the beginning of the period, we're going to find on the April 1st balance sheet, and in this case is $60,000. The inventory at the end of period we'll find on the April 30th balance sheet, and in this case that's $100,000. Now the cost of goods sold we'll find on the income statement or profit and loss dated April 1st through April 30th, and in this case that's $200,000. Finally, we need the days in the period, which are 30 days in the month of April. So we've got our formula and we've got our components, so let's take a look at the calculation. We're going to start off with our beginning period inventory of $60,000 and add that to the end of period inventory of $100,000. Then divide that total by 2 to get our average inventory. Next, we'll divide that total by the cost of goods sold of $200,000 and then multiply by the 30 days in the period. So, the average inventory is going to be $60,000 plus $100,000 divided by 2, which equals $80,000. We'll divide that $80,000 divided by the $200,000, which was our cost of goods sold, and then we'll multiply by the 30 days in the period. So we've got $80,000 divided by $200,000 multiplied by 30 days gives us 12 days in inventory. So what does that mean? It means it takes us 12 days to convert our inventory into sales. Okay, so as we saw on the whiteboard, the days in inventory in this case study was 12 days. Now, is 12 days good? Is it bad? It just depends on the business needs, the business itself, the industry. A much deeper analysis would be necessary. But what are we going to use days in inventory for, and how would you use it in your business? Well, you can use it to evaluate the performance of product lines as well as compare those product lines. You could use it to assist with timely procurement and management of your cash flow cycle. For more information on days in inventory and how it can affect your business and your cash flow, please visit us at pacificgrowthstrategies.com and book a free discovery call. Thank you for tuning in, and as always, we wish you continued success.